Hello friends, good morning and welcome to this analysis of AFM May 2024 exam paper, and I am also going to give you the step-by-step solution for all the question including the theory question. You can download the question paper with complete solution, step-by solution from our website vinod.in. Our website is vinod.in. You can go to the free resource section and you can download the entire question paper with solution. Those who have appeared for the exam, they can check to what extent they have got it right. We have given answer of only part 2, part B, descriptive question, because I have not yet received the MCQ questions. So in case if I receive MCQ question, I will prepare the answer for that. We have also uploaded the answer of FR paper, complete step-by-step solution on our website vinod.in, and the explanation is given on the YouTube channel AS Foundation. If you have not yet subscribed to the channel AS Foundation, subscribe it now and also share this video with all your friends in CA Final who have appeared for the exam or who have not yet appeared for the exam. It will be very useful to you. Now coming to the AFM May 2024 paper, it was one of the easiest papers I have seen in last about 20 years. Yes, all the questions, all the numerical questions were from your study material or your past exam RTP and MTP, and many difficult chapters were totally ignored. For example, foreign exchange management, they have not asked question on that, right? Or in derivative also, just one very basic question has been asked. They have asked questions from valuation of share, 2 questions on mutual fund, 2 or 3 questions on portfolio management. Lot of theory questions were there. There was question on mergers and acquisition, advanced capital budgeting. All these questions were from study material. As I always say, trust me, do not keep any topic for option. Nowadays there are lot of wrong way of explanation that certain topics are very important, certain topics are not important. Some of the faculties are wrongly classifying A, B, C category of topic. Please do not do that. Do not listen to such people. Trust me, you will face a lot of challenges in the exam. My simple advice is all topics are important. Chapter 1 to chapter 15, all topics are important, all concepts are important, all the questions appearing in the study material or which have been asked in exam, RTP and MTP are important. At least do this much. No shortcut. You can practice more, but you can't practice less. In case, if you are serious about your exam, if you are not, welcome, you do whatever you want, nobody can help you. Please only learn from experienced faculties. I am teaching for 21 years and I know there are a lot of surprises in the exam. Do not take this exam, May 24 exam, as a benchmark for November 24 exam. November 24 exam can be very different. This was probably the first exam under the new scheme. So FR as well as AFM till now have been very easy paper, but we cannot assure the same thing about November 24. Please study all topics. My formula is MMM. More practice, more confidence and more marks in the exam. MMM. More practice, more confidence, more marks. Otherwise, you will be stuck in the exam. So let us start with the analysis and solution of AFM paper for May 2024. The first question from portfolio management. The first question from portfolio management, several times we have done this question in the class. Same to same problem is also appearing in the study material. So the question is, an investor is holding 1000 shares An investor is holding 1000 shares of X Limited. Current year dividend is 3 rupees per share. So what will you call it? D0 or D1? So we are going to call it D0. The market price of this share, the current market price of this share is 35 rupees. I will use this number in my answer. The investor is concerned about several factors which are likely to change during the next financial year as indicated below. Now this is current year data and this is what can happen in the next year. So 2 times you have to solve. It is written dividend paid. This is paid 3 rupees already mentioned here. So this is D0 and anticipated dividend per share, this 3.25 is D1. 3.25 is D1. So if you are using anticipated column, revised column, then take 3.25 as it is. Next is risk free rate, RF is given, market risk premium means RM minus RF is given, beta is given, expected growth now, expected growth you are going to get in the next financial year. Advise the investor to take further action whether to buy, hold or sell the share based on the above information. So what I'll do, I will solve it twice. Good morning everybody who has joined this live streaming session, and please also inform your friends to join, otherwise they can watch it later on the YouTube channel AS Foundation. Okay, so I'm going to give you the answer. First we'll compute the existing rate of return, which is based on existing data. Based on existing data, risk free return is 11, risk premium is 4 and beta is 1.5, so it comes to 17%. Revised rate of return, which is based on this revised data, and this is your risk free return which has also changed to 12, and this is market risk premium and beta is also changing 1.6, so this comes to 20%. Based on original data, the share price is 35. Share price is 35. D0 into 1 plus G. Here we are given D0, so I need to increase it by expected growth rate of 8%. There is a small calculation error, I will rectify. It should be 3 into 1.08, 3 into 1.08, then divide by 17% minus 8%, 9%. So this is 36 rupees. Instead of 35, this is 36 rupees. And based on revised data, D1 is already given here 3.25. So take D1 as it is. Take D1 as it is. And then 20% is the new rate and 10% is the new growth rate. So that comes to 32.5. So existing price 36, revised price 32.5. Good morning Archana Agarwal. Good morning Ramesh. Thank you for joining. Please inform your friends also. There may be some minor calculation error because we have prepared this in a hurry, but please take care of the calculations yourself. Now I am going to give you a note. In case of existing market price of rupees 35 per share, the rate of return 17% and the possible equilibrium price at the rate rupees 36. The share needs to be bought. Write down bought. The share needs to be bought as the share is underpriced. The share needs to be bought at the share is underpriced. Existing price is 35. Based on existing data, it should be 36. So this is underpriced share. So based on existing data, my answer would be buy because underpriced. But based on revised data, existing price 35, revised data will give you 32.5. So your answer will be, under the changed scenario, growth of dividend rate is revised to 10%, return has been revised to 20%, and the possible price of the share will be 32.5. Therefore, investors should sell the share as the price is expected to decrease if other things remain the same. So thank you Raju Mehta for joining, and please also share this video with your friends. They might also need some guidance. Now I'll come to question number 1B. This is one of the highly repeated questions in the exam. Okay. There are 3 mutual fund schemes given to you. Like many problems, amount invested is given. Dividend received up to 31st March 23 is given. NAV on closing date. Closing NAV is given. Effective yield is given on 31st March. So most of the exam questions they ask you effective yield, but this time effective yield is given, and holding period is also given in days. Holding period is also given in days. So what do they want? You are required to compute NAV at the time of purchase. Missing figure is NAV at the time of purchase, and for calculation use 365 days in a year. So we have purchased this investment amount, but we don't know what was the NAV on the date of purchase. To help you, they have given you effective yield, they have given you holding period, they have given you closing NAV, they have given you dividend. So what I'll do, I will first write an equation and solve this equation. Based on this equation, you will be able to get the answer. So the equation for effective yield percentage per annum is dividend plus closing investment value. Closing investment value will be closing NAV plus number of units minus amount invested. So dividend plus capital gain divided by amount invested will give you holding period return. And when you multiply by 365 divided by holding period, that will give you effective yield per annum. Number of units is not given in the problem. Let the number of units be X. That is the starting point. Good morning Rishikeshan, good morning Satish. First mutual fund X, we'll have to solve one by one. Look at the question. Question is effective return is 19.345%, 0.19345. Please download the question paper with solution from our website vinod.in immediately. Keep it in front of you and you will be able to understand better. This is the sheet you will get, exactly same sheet you will get, and you can correct it also certain things if required. Okay, so this is the equation I will write. Dividend given 10,000, closing NAV 11.15 into number of unit X minus opening investment divided by opening investment into 365 by 120. When you solve this, you get 50,000 units approximately. Approximately means not exactly, because you might get 49,900 point something. So I have rounded off, and therefore NAV on the purchase date will be 5,50,000 is the total investment divided by units. Answer is 11. So if you have got 11 rupees or very close to 11, you will get how many marks? I think it was for 2 marks for each part. Total is 4 marks. So maybe you will get 2 or 1.5 marks. Same thing for mutual fund Y. Effective yield is given 22.5%, dividend is given 6,000, NAV 11, number of unit X, investment 4,20,000. Here the holding period is given in the problem 100 days. When I solve it, I will first get the number of units, 40,000 unit approximately. Because of rounding off, you might get 39,999 something. So don't bother, you can round off to 40,000 unit. The total amount invested is 4,20,000 divided by 40,000 unit, you get 10.50. Very easy question. Same thing for mutual fund Z, but in mutual fund Z, they have given you negative return, minus 36.5%, so which is minus 0.365, and then dividend is 0, closing NAV is 9.50, opening amount invested is 1 lakh, number of days held is 50. When I solve it, I get 10,000 unit, NAV per unit is 10 rupees. So the answer for this question is 11, 10.5 and 10 approximately. If you have got it right, then welcome, you will get full marks. And you can check also your answer. Once you have got the opening NAV, you can find out the effective return by taking dividend plus NAV 1 minus NAV 0 divided by NAV 0 into 365 by holding period. And if your answer matches with the effective yield given in the problem, then you are right. Good morning, Rajiv Sharma. Rajiv Sharma is All India ranker. He has written in his name AIR 10. I am also AIR 2 Foundation, AIR 4 Intermediate, AIR 24 CA Final, and I have passed IAS mains exam also 2 times. Okay, so don't think you are the only intelligent one. Now next is question number 1C was a theory question. The starting point of an organization is money and end point of organization is also money. Explain the statement to clearly understand this interface of strategic management and financial policy. This is from your chapter 1 of your AFM study material. Interface between strategic management and financial policy. So this is a theory question and I have given the answer taken from your study material only. This theory question you can just read yourself later. Download the notes from website vinod.in. Now we'll come to question number 2A. Again a question which has been repeated in the last few years, taken from past exam or you can say study material. You have to compute EMA, exponential moving average. They have given you data from 2nd January to 11 January, day 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and these are the days given. Day given Nifty. When there is no trading, you ignore this. It won't be required in your calculation. So total number of trading days 1, 2, 3, 4, 5, 6, 7, 8, 9. Little lengthy calculation, but you will be able to get it. Good morning, Amy Fanaskalkar, and please also share this video with your friend immediately. Take a pause, share it with all your friends groups, CA final groups. They will find it useful. And those who appeared for the exam, you please check your answer with my answer and you can easily calculate how much you are going to score. You are required to compute the exponential moving average of the Nifty during the above period. Previous day exponential moving average of Nifty can be assumed to be 21,500. So that is my starting point. And the value of the exponent for 31st date EMA is also given. When the institute gives you exponent, use the same. So the table heading calculation of EMA, I am not explaining this right now. We have already done 2 questions in the classroom and it is the same question, only these figures have changed. Otherwise, institute has even given this EMA factor same, which was taken in the classroom 0.062. So what is the formula for computing? You will write date, Nifty, previous day EMA, difference between Nifty and previous day EMA. That difference will be multiplied by factor 0.062 exponent, and the previous day EMA, column number this, plus this adjustment for exponential moving average factor, these two you will add and you will get the EMA for the day. So we have done this calculation. One line I am going to explain. This is 21,742 given in the problem. Please keep the printout of the question in front of you, okay, in case if you are serious. Then this is the previous day EMA given. We have taken the difference between these two numbers multiplied by 0.062. These two you will add, you will get 21,515. Same way you continue, and these are the EMA you will get. If you look at this EMA, you will observe that what do you observe? You will observe that they are falling, which means the trend is a falling trend. Trend is a falling trend. Based on the limited data given to us, we can interpret that the market is turning to be bearish, because only in the second day here there was a increase, but after that there is a continuous decrease. So the trend is, what is the trend? Bearish trend. The trend is a bearish trend, and therefore the answer is investor or the broker can take a short position. Is it right? Those who are attending online, please respond. Is it right? Question number 2B. Question number 2B, very easy question. Again, several times repeated. The question is also in the study material. In fact, all questions are in the study material. 2B, 4 marks. Question on computing cost of GDR or ADR. No change in the problem. Only some figures they have changed. XY is interested in expanding its operation and planning to install a unit at US for the proposed project. It requires a fund of $15 million net of issue expense and flotation cost. So 15 million should come in hand after incurring expenses, and the estimated flotation cost is 3%. So you need to raise 15 million divided by 97%. This much fund you will have to raise, because 3% will be spent on flotation cost to finance the project. It proposes to issue GDR, Global Depository Receipt. You as a financial consultant is required to compute the number of GDR to be issued. So the first question is number of GDR to be issued. So first I need to compute the amount raised, and that amount raised will be divided by issue price per GDR in dollar, and that will give me number of GDR to be issued. Second is the cost of GDR with the help of following additional information. GDR is also equity share only. So cost of GDR formula is D1 by P0 plus G. And to help you, they have given you this detail. Expected market price of the share at the time of issue of GDR is 350. One share is 350. Face value 100 rupees. This will be required for dividend calculation. 3 shares underline each GDR. So 1 GDR is equal to 350 into 3 and shall be priced at 6% discount. So in terms of Indian rupee, this is the price, but they are going to issue in dollar. So they have given you exchange rate rupees per dollar 84. So when you divide this by 84, you get issue price in dollar. Use that issue price in dollar here and you will get number of GDR to be issued, and dividend expected is 10%. See, the face value is 100 rupees. Face value is 100 rupees means dividend is 10 rupees per share into 3 share. So dividend per GDR will be 30 rupees. Okay. So D1 amount raised from GDR, this figure, minus 3% flotation cost will be P0, and growth rate is given 8%. So very easy question. This is the answer. Issue size is $15 million. Flotation cost is 3%. Gross issue is this amount. Issue price per GDR 987. Issue price per GDR in dollar will be 11.75. Dividend per GDR will be 30 rupees. Net proceed per GDR will be 987 into 97% because 3% is flotation cost. This is amount received in rupee per GDR after deducting flotation cost. Question 1. Number of GDR issued. This is your gross amount raised, and this 11.75 is your issue price per GDR. Therefore, please check the calculation. It comes to 1.3161 million GDR, and cost of GDR will be same formula which we use in the classroom, D1 upon P0 plus G. Okay. So dividend would be 30 rupees calculated here. Net proceed 957.39, growth rate 8% is given. Please check the calculation. 11.13%. Is the calculation right? Say yes or no. Is the calculation right? Kindly reply yes or no. Okay, now we'll come to question number 2C. It was from mutual fund. Very easy question for 4 marks. Okay, anybody could do it. Mr. A has invested in Grow Rich mutual fund scheme. The details of the mutual fund scheme are given below. Asset value at the beginning of the month. This is actually NAV 0, 78.50. Annualized return, that is return percentage per annum. So they have already done annualization 16%. Distribution made in the nature of income and capital gain per unit respectively. 0.40 is the dividend distribution, 0.30 is the capital gain distribution. You are required to compute the month end. So this is D. NAV 1 is missing. NAV 1 is missing of the Grow Rich mutual fund. Round off to 2 decimal. Comment briefly on the month end NAV. So one small comment also will write. What is the formula for computing annualized return? All of you know that. In fact, this question you can say is like a repetition within the same question paper. Some minutes back we have done this. Annualized return percentage equal to dividend per unit plus capital gain distribution per unit plus closing NAV minus opening NAV divided by opening NAV. Because the figures are in months, I will take 12 divided by holding period. In earlier problem it was in days, so I have taken 365 divided by number of days. So don't worry, let the closing NAV be X. This is your missing figure. Closing NAV is what they want. Your annualized return is given 16%. So take 0.16. If you want to take 16 here, then multiply by 100 here. Then it will be okay. Is it right? Your left hand side of the equation and right hand side should match. Okay, so let us continue. Dividend, capital gain, closing, opening, divide by opening into 12 by 1. When you will solve it, you will get 78.85. In the exam, you can quickly cross check by putting the value of 78.85 here and if you are getting 16% as the answer, that means you are right. So you can always cross check your answer whether your calculation is right. They have asked you to comment also. The month end NAV is higher by 0.35. Opening was 78.50 given in the problem, closing is 78.85. So there is an appreciation in NAV by 0.35. Why the NAV appreciates? NAV appreciates because the portfolio held by mutual fund must have also appreciated. Okay, so that is the small comment I can write based on the limited data. This is the question from interest rate risk management, and this question has already been asked in the RTP, MTP and I think study material also. I have seen this question in RTP and MTP. Recently in the regular class and revision batch also we had taken this question. Same problem, of course some numbers are different. So are you there? Are you listening to me? Question number 3A. Very easy question. A manufacturer of electronic components has taken floating rate loan of rupees 2 crore on 1st April 2023. The rate of interest, so the amount is 2 crore and the rate of interest is 9%. Interest is paid on 31st March every year. In the month of October 2023, Central Bank of the country, means RBI, releases the following projections about the interest rate prevailing in future. This is the projection given by Central Bank. Okay, this is the projection given by the Central Bank. This company has taken floating interest rate loan. So if the market rate goes up, you pay more. If the market rate goes down, you pay less. So what are the projection of the Central Bank? You can see these are the projection for next 5 years, and you will find except the last two, in the first 3 years the interest rates are expected to rise. The interest rates are expected to rise. So what we are going to do? We are going to protect ourselves from rising interest rate. We have taken a floating rate loan. Interest rate might rise as per the indication given by the Central Bank, and therefore we need to do hedging. You are required. Who is required? You, the student, is required to show how the borrower can hedge the risk using option cap. Means you will have to buy a call option on interest rate, which will ensure that you don't pay more than a certain rate. However, you can pay less than a certain rate, arising out of expected rise in the rate of interest when he wants to pay his interest cost at 9% per annum. So this borrower does not want to pay more than 9% per annum. So he should enter into a call option contract which will have an exercise price of 9%. The cap rate will be 9%. If the interest rate goes above 9%, he will pay 9%. But if the interest rate goes below 9%, he will pay the lower rate of interest. To get this benefit, he will have to pay the premium. And they have written also, assuming that the premium negotiated by both parties 0.8%. So you will have to pay 0.80% of 2 crore rupees as one time premium to be paid at once, one time premium on 1st October 23, and the actual rate of interest on the respective due date happens to be, this line is important, actual rate of interest happens to be. So in order to compute the gain or loss, I need to take actual rate. I don't have to take the projected rate of the RBI. I have to take the actual rate. Some student can make a mistake. What is the mistake you can make? You might take the projected rate of the RBI. You might take these rates given in the first paragraph. You don't have to take that rate. That is the projected rate. For the purpose of computing gain or loss, I need to take the actual rate. I need to take the actual rate for comparison. We are going to compare this with 9%. If it has gone above, then we are going to get the difference. If it is going below or equal, we are not going to get anything. So we are going to get 0.5% difference, 2% difference, 0.25% difference, and we are not going to get anything in the last two column. And this difference will multiply by 2 crore. You will calculate how much difference you will receive. That's it. You are required to show how the settlement will be executed on the respective interest due date. These differences multiplied by 2 crore. Because you are going to take a cap, you will not pay more than 9%. Third question, theory question of the same problem, but theory question, state whether this option is advantageous when compared to interest rate collar option. In interest rate collar option, you buy a cap and you sell a floor. The advantage of this is premium is reduced, but the disadvantage is if the market rate goes below floor rate, you will not be able to take advantage of that, and therefore it is interest rate option has some advantage over collar, although it will be more costly, but you will be able to enjoy the benefit if the market rate of interest falls. So that small note we have to write. So how do you present the answer? First you will write what as a borrower you are supposed to do. The borrower does not want to pay more than 9% per annum. On this loan, where the rate of interest is likely to rise beyond this, hence he has to hedge the risk by entering into an agreement to buy interest rate cap on the following parameter. So he will have to enter into an interest rate cap. Following terms and condition will be applied. The notional principal amount will be 2 crore, strike rate will be 9%, reference rate will be the rate of interest applicable to this loan. Then calculation and settlement will be done 31st March every year. Duration of the cap will be till 31st March 28. Premium for the cap is negotiable between both the parties, which is 0.8%. Now to purchase this cap, the borrower is required to pay the premium upfront. Premium is required to be paid upfront. The payment for such premium will entitle him with the right to receive the compensation from the seller of the cap if the interest rate goes above, make it 9%. If the interest rate goes above 9%, the compensation at the rate will be difference between the rate of none of the case, the cost of rate of will be the difference between the rate, just forget this line, some drafting mistake. This implies that in none of the cases the cost of the loan will rise above 9%. The hedging benefit is received at the respective interest due date at the cost of premium to be paid only once. So let us come to the calculation part. The student is saying on 31st March 24 there will be zero payment. You are not right. On 31st March 24, please see, the market rate is 9.5% and the strike rate is 9%. So you will get 9.5% minus 9. Okay, it has gone above. Settlement will be based on the rate prevailing on this date. Now I'll come to the premium to be paid on 1st October 2023 will be 2 lakh into 0.8%, 1,60,000. Payment will be made at the beginning. Now we'll come to next point. 31st March 24. Please follow the discussion, you will get your answer. There is a query on 31st March 24. They are going to see what is the rate of interest now which is applicable for the coming year, which is 9.5%. But my cap rate is 9. You have to see the actual rate, not the rate announced by central bank as projected rate. 9.5. I will show you the table again. This is 9.5. Here the rate of interest is 9.5 for the upcoming year. So I am going to take the difference, 0.5% multiplied by 2 crore. 0.5% of 2 crore, we are going to get 1 lakh. 31st March 25. Now the rate is 11. Cap rate is 9. We will receive compensation of 2% on 2 crore. The answer is 4 lakh. On 31st March 26, the rate is 9.25. Cap rate is 9. We will get 0.25% of 2 crore. That is 50,000. 31st March 27, cap rate is 9, actual rate is also 9. So option will lapse. And if option will lapse, there is no compensation. You will end up paying 9% only. Your cost will not exceed 9%. Then the last one, 31st March 28. Here the actual rate is below your cap rate of 9. So option will lapse. And you will pay 8.5%. Interest liability shall not exceed 9.5%. It will pay 8.5%. 8.5%. So in all the 5 cases, the interest cost does not exceed 9%. So you have to write a note. By paying the premium upfront, buyer of the cap gets the compensation on respective interest due dates without any obligation. Why interest rate option is better than interest rate collar? In case of interest rate option, you fix the upper limit, but at the same time when the market rate goes down, you will let the option lapse and enjoy the fall in the market rate, like in case of 31st March 28. But if you take collar also, then you are going to limit the lower rate at which you will have to borrow. So the benefit of collar is cost will reduce, but you will not be able to enjoy the flexibility which call option offers you. So I have written a note for you. You can write similar note in the exam. Interest rate provides more flexibility compared to interest rate collar. With option, the buyer has the right but not the obligation to execute the trade at predetermined rate. This means that if market changes favorably, if the market keeps on falling, you will benefit. The buyer can choose not to exercise the option and pursue more advantageous opportunity. Interest rate collar, this is the drawback of interest rate collar, limits potential gain if interest rate moves in a favorable direction. That was question number 3A, based on interest rate risk management. Dear students, we have prepared this very important book called Integrated Business Solution Book. We have compressed the book only in 400 some pages. We have redesigned the book. Can you see that? And we have prepared one very wonderful index like this. I'll show you. Let me just bring it like this. You can see the index is prepared like this, which gives you what is the content of that topic, which subjects are covered, which topics are covered, what is the starting line of this topic. If you carry this book in the exam, you can easily find out any question if asked in the exam. Nowadays there are few questions which are repeated. We have also removed all those questions which were duplicated. So in some books you will find there are 100 case study, but out of that around 18 question or 18 case studies are repetition. So there is a wastage of time and page and effort. We have removed those duplications, right? So you can purchase this integrated business solution book from our website vinod.in or Amazon or even Flipkart. So wherever you are comfortable, you can place the order for IBS book, and you are also going to get this AFM summary chart and formula book worth 600 rupees free along with this IBS book. We have got lot of students who have purchased this IBS book, summary chart book, and they have tremendously benefited from this. Thank you, and let us continue. So next question number 3B. Apart from the support from government, there are quite a few other reasons why India became a sustainable environment for startup to thrive in. What are the other reasons? In India, startup culture is growing. Government is giving a lot of benefits. Other than government benefit, why startup culture is thriving in India? So one is Shark Tank, okay, but don't write in the exam because people get inspired. They think it is easy to raise funds. Okay, so that is there. That is also mentioned here. Variety of funding options available. So India has developed, as far as startups are concerned, lakhs of startups have registered with the ministry. The reason is pool of talent, cost effective workforce, internet is easily and available at a very affordable rate. Technology is one of the important game changers, and now there are a lot of funding options available. There was one choice element here. Tokenization to some extent resembles the process of securitization. This question is from the topic securitization. It is there in your study material also. What are the similarities of tokenization and similar securitization? So I have written the same answer which is printed in the study material. Liquidity, diversification, trading, new opportunities. You can read the answer by downloading our question paper and solution from website vinod.in. vinod.in. Go there, this paper and the solution both are appearing. You will be able to download it. Question number 4A. This is the only simple question on derivative option they have asked, and this question is there in the study material and repeated in the exam so many times that by reading the first 2-3 lines only you will understand what they are going to ask. Market received some information about ABC tie-up with a multinational company. This has induced the market price to move up. If the information is false, ABC stock price will fall dramatically. To protect from this, the investor has bought, underline bought, because he will have to pay the premium on both call and put option. He will have to pay the premium on both call and put option. He purchased one 3-month call at a strike price of 45 by paying 3 rupees premium, and he paid 2 rupees premium for a 3-month put with a strike price of 42. So these are the two strike prices we have to keep in mind. For call option 45, for put option 42. Call will be exercised if market price goes above 45. Put will be exercised if market price falls below 42. You and one more number, 100 shares, assume 100 shares for call and put. So multiply by 100 for calculating premium, for calculating profit and loss. You are required. Again, you are required. But most of the task is now done by teachers only. You are required, you means I am required to determine the investor's position if the tie-up offer bid the price of ABC stock up to 44 rupees in 3 months. 44 is somewhere between these two. Both options will lapse, and whatever premium you have paid is your loss. To determine the investor's position if the tie-up program fails and the price of the stock falls to 34, put will become exercisable. 42 minus 34, call will lapse, and whatever premium you have paid, deduct that will give you net profit. Okay, and to determine the investor's position if the tie-up program successful and the price of the stock rises to 46, call will become exercisable. 1 rupee profit on call, put will lapse. Profit on call minus premium paid is your net payoff. So the answer is very easy. I will read one by one. First, compute the total premium paid. On call option we will pay 3 into 100, 300. On put we will pay 2 into 100, 200. Total premium 500. Case 1, price goes to 44. Investor will not exercise both the option. Ending value will be 500 premium paid, 0 gain, 500 loss. Net loss 500. First answer, net loss 500. If the price goes to 34, then call will not be exercised because market price is below exercise price. Put is valuable, put will be exercised. Total premium paid 500. Ending value will be minus 500, and the profit on put option, which is 800 rupees. So still we will have a net gain of 300 rupees. And if the price goes to 46, oh my God, put is worthless. Put will not be exercised, but call will be exercised. Total premium paid remains 500. Ending value will be minus 500, and profit on call option 100 rupees. Still we will have a net loss of 400 rupees. That was a very easy question. Now 4B, question on merger. There were 2 questions on merger. Surprisingly, there was no question on forex. Okay. So those who think that forex is the only topic we have to master, they will be taken for a surprise by this exam. Study all topics. There is no concept of ABC in AFM. If somebody tells you, block his number. Okay. Misguidance will cost you a lot. Learn from experienced faculties only. Either other faculties also who are experienced. Okay. PQ Limited plans to acquire RS Limited. PQ is acquirer, RS is target. The financial details of the 2 firms prior to merger announcement are. So this is the market price and number of share for 2 companies. So market capitalization of PQ will be 100 into 20 lakh, 2000 lakhs, and market capitalization of RS will be 50 into 10, 500 lakhs. The expected synergy is 300 lakh. So total market value after merger is 2800 lakh. The exchange ratio agreed is 0.5. Exchange ratio is also given. There are 10 lakh share. So number of share issued will be 5 lakhs. Number of share issued will be 5 lakh. This company already has 20 lakh share. So 20 plus 5, total number of shares will become 25 lakh. You are required to calculate the true cost of merger from the point of view of PQ. PQ is the acquirer. Very, very easy question. This similar question was asked in the exam also. It is there in your study material also. So what I need to do? First I need to calculate number of share issued, 5 lakh. then we'll calculate what is the stake of shareholders of RS Limited. What is the stake of shareholders in RS Limited in the merged company? They will get 5 lakh share divided by total 25 lakh share. So they will be having a stake of 20% in the merged company. PQ Limited is giving 20% stake in the merged company to the shareholders of RS. This is my total valuation after merger, and we are giving 20% of that to the target company. So target company gets shares worth 560. Target company gets shares worth 560. And what is the standalone value of the target company? The standalone value of the target company is 500 only. So 560 minus 500, the difference is true cost of acquisition from the point of view of acquirer company PQ Limited. Okay. If they ask you NPV of target company, if they ask you, then that will also be 60 lakhs. NPV of target company will be 60 lakh. Is it right? The answer is on the screen. Have a look at it. You can download the answer sheet from our website vinod.in. Next question 4C was a theory question. What do you mean by IFC? That is gift city and benefits of IFC. So I have written the meaning. You can check later, and benefits of IFC. Like in Gujarat we have this gift city, and it is very, very popular, and it is giving lot of opportunities to our professionals. It has got lot of flexibility, lot of tax advantage. It is as if it is a separate country within the country with a separate set of rules, where huge financial opportunities are there. Question number 5A from portfolio chapter. Same question in the study material. Same question we have taken in the class also. You can see in our class notes, question number I think 30 on portfolio, same question. You are so lucky, those who appeared in this exam, that most of the questions were already covered in the class. Not most, we can say all questions were covered. Only you have to change the numbers. An investor has decided to invest rupees 1 lakh in shares of X and Y. The desired return from the shares of the two companies along with their probabilities are given below. These are the probabilities. Return of X Limited, return from Y. Very easy question. Compute, what is the calculation required? Risk and return of investment in individual share. Very easy. Compare the risk and return of these two shares with a portfolio of these shares in equal proportion. So 50% in X and 50% in Y. And one more question, find out the proportion of each of the above shares to formulate a minimum risk portfolio. What should be the weight of X and what should be the weight of Y, so that you create a portfolio which will have the minimum risk. So first what I will do, first I will prepare a table. This table will be very, very useful for calculating expected return, standard deviation, covariance, which we will require for answering all the questions. So in this table we have the same format. We have done this several times in the class. Probability, return on X, return on Y. Multiply these two, P into X, multiply probability into return of Y. Calculate deviation of the two stock from the mean. In order to calculate standard deviation, we will take P into X minus X bar square, P into Y minus Y bar square. In order to calculate covariance, we will take P into X minus X bar into Y minus Y bar. First you copy these 3 columns as it is from the question. Okay. Just let me check whether I have typed the correct number. One second. This is the original paper I have. Yes, I am right. Sometimes I am also right. So minus 5, 10, 15 and 15, 25 minus 10. If this is right, then I think my calculation is right. So you will multiply probability into return. You will get 8.5% return on X, 12.5% return on Y. Then you will compute the deviation from the mean. Minus 5, 10 and 15. These 3 minus 8.5 you will do. You get this column. Y minus Y bar. You get this column. Then you take P into X minus X bar square. P into Y minus Y bar square. This column you will get 50.25. This you will get 231.25. And this column P into X minus X bar into Y minus Y bar. P X minus X bar, Y minus Y bar. This is called covariance. That column is covariance. In this column, take the square root. You get the standard deviation of X. And in the next column, you get standard deviation of Y. Now I am ready for solving all the questions. The first question is, what is the return on stock X? What is the return on stock X? Just a second, please. Some problem. I will start again, don't worry. All of you must have got it right, I am sure. Okay, back to business. So return on stock X will be this number, 8.5. Return on Y will be 12.5. Standard deviation of X will be 7.09. Standard deviation of Y is 15.21. This is covariance. First, what is the expected return of the portfolio which has 50% of X and 50% of Y? So the answer will be 10.5. And standard deviation of portfolio, using this formula, your answer is 7.06%. Using the formula of 2 stock portfolio. And then minimum variance portfolio. We have already computed covariance. So the formula to be used is sigma y square minus covariance of X and Y upon sigma X square plus sigma Y square minus 2 covariance of X and Y. So this is sigma Y square. You can take directly this number. This is sigma Y square. Minus covariance. This covariance is already negative. So minus will become plus in calculation. This is sigma X square. You can directly take 50.25 or you can take square of standard deviation. This is sigma Y square minus 2 into minus 41.25. When you do the calculation, you should get 74.86%, and weight of Y will be balancing figure 24.14%. Please check the answer. Is it right? If it is right, let us go to 5B. 5B, another easy question, highly repeated question. XY Limited paid a dividend of 3 D0 for the current year. dividend is expected to grow at the rate 30% for next 5 years, 30% for next 5 years, and at 15% per annum thereafter. Okay, so this is a two-stage growth model. For first 5 year growth rate is 30%, and then 6 to infinity growth rate will be 50%. Now they have given you the return on 182 treasury bill is 12% per annum. This is called risk-free return, and the market return is expected to be around 16%. This is RM. Variance of the market portfolio is 24%. This is sigma m square is given, 24%. Covariance of return with the market is 34%. So you should know how to compute beta. Beta is equal to covariance with the market upon variance of the market portfolio. Have you learned this? If yes, you can solve it. So first we will compute beta. How my thought process will start after reading this problem? First beta, then you compute required rate of return, which is a part of the question also, and then in the third step we will compute the intrinsic value. And to help you, they have given you PV factor at 17%. So indirectly there is a hint in the problem that your required return will come to 17%. Let us check. So please focus. Beta formula is covariance of the stock's return with the variance of the market portfolio. Both are given in the problem. 30 divided by 24. 30 divided by 24, 1.25. Then you compute required return using CAPM, you get 17%. Compute intrinsic value of the share. First 5 year, 3 rupees increase by 30% for 5 years. You will get these numbers. First 5 year factors are given. Take the same. When institute gives you factor, use the same. Take the total. Then compute the terminal value by preparing a working note. Take the last dividend paid. Growth rate is 15%. Divide by cost of equity minus growth rate. It comes to 640.421. Multiply this by 5th year factor. You get 292.0593. 20.80 is the PV of dividend. 292 is the PV of terminal value. The total of these two together is called intrinsic value of the share, 312.86. You can round off in 2 digits, no problem. Okay, so this was my question number 5B for 6 marks only. Question number 6A, taken from Advanced Capital Budgeting study material. This question is in Advanced Capital Budgeting chapter. Okay, and this question is based on optimum replacement timing. So I am just going to tell you that we have recorded AFM in Hindi as well as English. We have recorded the lecture by taking questions from all the study material, RTP, MTP, past exam, and some good reference books also. Our lectures are very comprehensive. One thing I can assure you, you will not find any other video lecture as comprehensive as our class notes. That is my assurance. We have prepared 2 modules which will cover all 15 chapters. This is module 1 of Advanced Financial Management, and this is module 2. You will get these 2 modules. In addition to these 2 modules, We will also provide you this summary chart and formula book, which will cover summary of all the chapters and all the formula at one place, and we will also provide you this MCQ book, very comprehensive MCQ book on all topics we have prepared, and very high quality MCQ which will be useful for the exam. So you will get all this study material along with our video lecture, and our video lecture pricing is very reasonable so that most of the student can benefit, and it is only rupees 6,000 whether you purchase in Hindi or English, and you get 5-year validity. 5-year validity. So I am sure you will not require for 5 years. You will pass much before that. So let us solve question number 6a. Very easy question if you have done it in advance. If you have not practiced before going to the exam, then there is no point in trying in the exam. You will not get it. A machine used on a production line must be replaced at least every 4 years. At least every 4 years means you can replace either in year 1 or year 2 or year 3 or year 4. But after 4 years you have to replace. There is no choice. Cost incurred to run the machine according to its age are. So when you purchase the machine 1 lakh, if you go up to 1 year, you will incur maintenance 18,000, repair 0, and you will get scrap value 35,000. If you go to year 2, then you have to incur both year 1 and year 2 maintenance, year 2 repair, and you will get 23,000 rupees scrap value. Same thing if you go up to year 3, you will incur repairs and maintenance for all the 3 years, and you will get the scrap value of the 3rd year. Scrap value of only that particular year you will get if you replace at the end of that year. And if you go up to 4th year, you will incur repair, maintenance, and you will receive scrap value. These first 3 lines are your outflow, and scrap value is your inflow. So while solving the problem, be careful. Future replacement will be with identical machine having same cost. Revenue is not affected by the age of the machine. So we are not going to discuss revenue, because revenue does not get affected whether you replace it after 1 year, 2 year, 3 year or 4 year. Ignore income tax and inflation. Very good. Enjoy. And determine the optimum replacement cycle. So we have to basically answer whether we should replace this machine every year, or every 2 year, every 3 year, or every 4 year. So how do I take a judgment? Treat it like you are given 4 choices in intermediate syllabus. There are 4 machines. One has a life of 1 year, one has a life of 2 years, one has a life of 3 years, and one has a life of 4 years. How do I compare them? I will compare them by computing equivalent annualized cost. I will not compute equivalent annualized benefit because there is no revenue model. We have to minimize the cost. So that option where equivalent annualized cost is minimum, that option we are going to exercise. Okay. So one by one we will solve. The discount rate is 15% and factors are given. I am going to use the same factor. Suppose we replace it after year 1. What are my cash flows? I will have to buy machine for 1 lakh. Year 1 repair and maintenance 18,000. I will get scrap value or residual value 35,000. I will write PV factor as given in the problem. I will compute the NPV. The NPV comes to 85,217. The students are requested to please check the calculation themselves. If there are some calculation error, please let me know. divide by PV annuity factor for 1 year. For 1 year. For 1 year the factor will be same. When you divide this by factor, you get equivalent annualized cost 97996. This is the cost per annum if you replace every year. If you replace every year, you are going to incur in equivalent terms 97996. If you choose 2-year replacement cycle, then write all cash flows of 2 years. Year 0 1 lakh, year 1 repair maintenance 18,000, year 2 repair maintenance 20 plus 3 23,000, and residual value you will get 23. Write the factors from the question book, multiply, take the total. This is my NPV for 2 years, divide by PV annuity factor for 2 years, 1.6257, divide, you get equivalent annualized cost 71120. It is equivalent to incurring 71,140 if you keep on replacing after every 2 year. If you replace after every 3 year, my cash flow will be cost of machine, repair, maintenance for 3 years, 18, 23 and 28, and salvage value will be 12. NPV will come to this amount, 143,563. Check. Annuity factor 2.2832 for 3 years and 15%, and your equivalent annualized cost 62,878. Then same thing will do for 4 years also. Cost of machine, repair, maintenance for first 4 years, and then salvage value inflow 6,000 in the 4th year. Factors are given in the problem. Kindly multiply and please check the total. NPV comes to 167,463. Divide by annuity factor for 4 years and 15%. Your equivalent annualized cost comes to 58656. Now this is the lowest. This is the lowest. If this is the lowest, your optimum replacement cycle will be 4 years, because your equivalent annualized cost is lower. So you buy the machine, use it for 4 years, replace it here, again use it for 4 years. So optimum replacement cycle will be 4 years. Now the last question, number 6B. Okay, that was highly easy question, very easy, taken from mergers and acquisition. Question is in the study material. The equity shares of XYZ Limited are currently traded at rupees 34 per share in the market. Underline 34. XYZ has a total of 10 lakh equity share outstanding. This is the number of share, price per share. You can compute the market capitalization of XYZ and in number, and the promoters equity holding in company is 30%. 10 lakh into 30% means promoters are holding 3 lakh shares. ABC wishes to acquire XYZ because of likely synergies. Estimated PV of this synergy is 1 crore. So important number, 1 crore. If ABC acquires XYZ, there will be synergy benefit of 1 crore. Further, ABC Limited feels that management of XYZ has been overpaid. XYZ management are getting more remuneration than what they deserve. With better motivation, lower salary and fewer perks for the top management will lead to a saving of 5 lakh per annum. Top management with their families are promoters of XYZ. So top management is nothing but the promoters only. The promoters are holding 30% share of XYZ. So if they take lower salary, lower perks, it will save 5 lakh rupees per annum, and the present value of this savings comes to 25 lakh. So this is one more benefit. Two benefits. One is operational synergy, 1 crore, lower salary, lower perks, lower compensation to top management will save 25 lakh rupees in present value terms. Following additional information is given regarding ABC. Acquirer company, EPS 5 rupees, number of share 15 lakh, market price 30. So this is the market capitalization of ABC. 15 lakh into 30, 450 lakhs is the market capitalization of ABC, and market capitalization of this company was 10 into 34, 340 lakh, and if the two companies merge, there will be 1 crore rupees extra because of synergy and 25 lakh rupees extra because of reduction in salary. Calculate the maximum price per share ABC can offer to pay for XYZ. Suppose you are ABC, how much maximum you can pay per share? You will say, I will pay what I will get. You will get a company whose value is 10 lakh into 34, plus it will give you a synergy benefit of 1 crore, and plus you are going to get a benefit of reduction in salary of 25 lakh. This is the total benefit you as an acquirer will be getting, and divide by 10 lakh share. That is the maximum you can pay. That is the maximum you can pay. Is it right? Second question is compute the minimum price. Compute the minimum price per equity share at which XYZ management, of XYZ will be willing to offer their controlling interest. So management of XYZ would want how much? Minimum, not maximum, minimum. So they will want, they are already having a valuation of 34 rupees per share into 3 lakh share, plus they are going to sacrifice 25 lakh rupees salary in present value terms. So they would want that I must get my existing share value plus loss of remuneration. At least that much I should get. At least that much I should get. Okay, synergy will arise only if the two companies merge. But the minimum value is what I am already enjoying. I am already enjoying the value 34 rupees and salary and perks, but that salary and perks, if I lose, I should be compensated for that. So now you see the first answer. First answer is maximum price per share which ABC can offer to pay for XYZ. Market capitalization of XYZ, 10 lakh into 34, 3 crore 40 lakh. Synergy gain 1 crore. Saving due to overpayment 25 lakh. Check the total, 4 crore 65 lakh, and divide by 10 lakh share. That is a maximum price 46.50 rupees per share. You can stop here the first answer, but in the study material of the institute they have given you one alternative answer also, not required in the exam. You can answer one of the two only, and this first part is easy to understand, easy to explain. But still I will explain the second part also in case if you have done it like this, you are right. Let the exchange ratio be ER. So this company, the acquirer company would want that the market price should not be falling below 30. The shareholders of acquirer would not want to have a dilution in the market value. They want 30 rupees in any case even after the merger. So 30 will be the desired market price. For that we have to see how many shares we'll have to issue and what should be exchange ratio. This is the market capitalization of XYZ. This is the market capitalization of ABC. This is synergy gain. This is saving due to lower salary and perks payment. Divide by number of shares of ABC and number of share issued to XYZ, 10 lakh into exchange ratio. When I solve it for exchange ratio, I get 1.55. Share exchange ratio should be 1.55. 1.55 share against 1 share in XYZ. Then the market price or the amount per share should be P ratio of ABC into EPS of ABC into exchange ratio. P ratio of ABC will be 30 by 5. 6 into EPS 5, 30. In fact, you can take directly 30 also. Institute has unnecessarily complicated. Multiplied by exchange ratio 1.55. So per share maximum they can pay is 46.50. If you find this complicated, don't write. If you have understood it, you can write. And the last part, minimum price per share at which management of XYZ will be willing to offer their controlling interest. That is very easy. What is the value of their 30% stake today? 30% of 10 lakh, 3 lakh share into 34. But if they sell their controlling stake, they will lose that salary and perks which they were enjoying, which is 25 lakh in present value terms. So the total value they are looking for is at least equal to what they were getting in the old firm. That is value of their share and perks, compensation, salary 1 crore 27 lakh, number of share 3 lakh, divide this by 3 lakh, and the minimum price which they must enjoy is 42.33. They want 42.33. This company maximum they want to pay 46.50. Will the deal be done? Yes, the deal will be done because the maximum price they want to offer is greater than the minimum price which the target company is asking for. Okay, so this completes my discussion on AFM May 2024. In case if you have any doubt, you can mail me on my personal mail ID vinod_ca@yahoo.com. Please share this video with your friend. You can WhatsApp or call on our number 97669 21860. Please note down and store in your mobile phone 94223 65495. Okay, I would request you not to raise academic query on YouTube chat. You can raise question relating to FR or AFM subject directly to my mail ID or WhatsApp number. Okay, some students are writing query on YouTube. It is difficult to answer on YouTube. You can write it, but then better it would be, if you are seriously asking the question, it is better you write directly on our mail ID or WhatsApp number. You can purchase our AFM video lecture from our website vino.in. You can also ask your friends to watch this video on YouTube channel AS Foundation. If you are still watching it, please share this video with all your friends in CA Final. They will definitely be benefited. So thank you very much and I wish you all the best. Bye bye, take care.